Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to be introducing the allowance for receivables account. We're going to be discussing what the allowance actually is, how you account for it, and then we'll run through a sample exam question so you can see how this topic could actually be tested in the Accounting Fundamentals exam. So yeah, let's get started. Okay, so an irrecoverable debt is where a business knows that one of their customers won't be able to pay an amount that's owed to them. But what happens when a business has a reasonable degree of confidence that a customer might not be able to settle their debts in the future, but isn't 100% sure that this will happen? Well, in these cases, a business creates what's called an allowance for receivables, which is an estimate of the amount it doesn't expect to recover from its outstanding trade receivables. So this allowance is usually calculated as a percentage of its trade receivables amount based on past experience, customer history, and other relevant assumptions such as changes in the broader macroeconomic environment. It's important to understand that the allowance is a judgment-based figure, so unlike irrecoverable debts, which are specific and objectively written off, an allowance for receivables is more subjective and is anticipating likely future losses before they actually take place. So it's more about expectation. So we're recording losses before they actually take place. So let's walk through how we account for an allowance for receivables in the financial statements, assuming this is the first time the business is recording one in its accounts. So we start by debiting the irrecoverable debt expense account. So this appears in the income statement, typically within administrative expenses. This reflects the expected future loss from customer debts that might not be paid, and therefore this journal entry is going to reduce the business's reported profit number. The credit entry is posted to a nominal ledger account called the allowance for receivables. Now this account, what's important about this account is it's not going to appear as a separate line on the balance sheet. Instead, how we reflect it is we net off the allowance amount from the trade receivables balance. So this gives a much more realistic view of how much the business actually expects to collect from its trade receivables. So to summarize, the expense goes through the income statement while the allowance reduces the trade receivables figure on the balance sheet. So this makes both financial statements more reflective of expected future outcomes. Now let's say the business has already recorded an allowance for receivables. So what happens if circumstances change? If the risk of customers defaulting increases, then we need to increase our allowance for receivables. How do we record this in the financial statements? Well, we need to debit the irrecoverable debt expense account, and we credit the allowance for receivables to increase the allowance. But if conditions improve, so maybe customers are paying their debts more reliably, then we need to reduce the allowance for receivables. So how do we record that? Using journal entries. Well, what we need to do is we reverse the original journal by debiting the allowance and by crediting the irrecoverable debt expense account. So this adjustment ensures that both the income statement and balance sheet reflect the most up-to-date view of customer payment risk. Cool. On this slide, one thing I want to make really clear is how the allowance for receivables is presented in our accounts and in our financial statements. The key point is that it's recorded in its own separate nominal ledger account, but it doesn't appear separately on the balance sheet. So when we prepare the balance sheet, trade receivables are always going to be shown net of the allowance. So in the nominal ledger, the trade receivables and the allowance for receivables are shown separately. They have their own separate accounts, but on the balance sheet, they're combined, and trade receivables is presented net of the allowance. So always read your exam questions carefully. Is the exam question asking you to calculate the trade receivables balance in the accounts, which is presented gross of the allowance, or is it asking you to calculate the trade receivables figure as presented on the financial statements, which is net of the allowance for receivables? So on this example on the slide, trade receivables in the accounts are presented gross of the allowance, so trade receivables 20,000, and the allowance is also presented separately as its own separate distinct nominal ledger account at 1,000, but on the balance sheet the net figure is presented, so the 19,000, which is equal to the 20,000 less the allowance of 1,000. So let's take a moment to make sure we're completely clear on how irrecoverable debts differ to the allowance for receivables. So irrecoverable debts are certain. We know that a specific customer won't pay, so we write off that receivable amount immediately. There's no judgment involved. But in contrast, an allowance for receivables is based on a prediction. It's based on our experience and on the balance of probability that we estimate that a percentage of customers won't be able to pay off their debts in advance of them actually happening. So when we record an irrecoverable debt, we're reducing the receivables balance directly in the nominal ledger account. But when we record an allowance for receivables, we create a separate account, but the trade receivables balance on the balance sheet is always presented net of that allowance. In both cases, the income statement records an expense, but only the allowance requires careful judgment about the future. And both the irrecoverable debt and the allowance reduces net profit and total assets. Okay, let's walk through a sample exam question. We're told that Bangor PLC began trading on the 1st of January 20x1. During its first year of operations, the company made £21,000 worth of credit sales and received £17,000 worth of cash from those credit customers over the course of the year. Now, during the same year, £400 of customer debts were written off as irrecoverable. At the end of the year, on 31st of December 20x1, the directors reviewed their outstanding receivables and decided to set up an allowance for receivables to reflect the risk that not all their customers would pay. So they judged that 10% of the closing trade receivables balance was likely to be uncollectible based on customer history and on their experience of managing customer debts. So our question is to calculate the trade receivables balance that belongs on the balance sheet at the end of the year. So let's break down this question and work through it step by step. So step one, we need to calculate the closing trade receivables balance before we factor in the allowance. So trade receivables before allowance, credit sales for the period. We subtract £17,000 worth of cash collections, the cash received from customers, and we also need to subtract £400 of irrecoverable debts that have already been written off. So that gives us a closing trade receivables balance before we account for any allowance of £3,600. Our second step is to apply the 10% allowance. So our allowance for receivables is calculated based on the remaining receivables balance of £3,600. So £3,600 times 10% equals £360. So if we were asked to determine the journal entry here that we needed to post, we'd be debiting irrecoverable debt expense by £360 and we'd be crediting the allowance for receivables by £360. So this will reduce net profit in the income statement, and it will also reduce receivables on the balance sheet. So with that in mind, we've been asked in the question to calculate the carrying amount of receivables that will be reflected on the statement of financial position. So to do that, to calculate that net receivables amount that's presented on the balance sheet, we take the gross trade receivables and we deduct the allowance for receivables. So we take £3,600, we deduct the £360 allowance, which gives us net trade receivables to be presented on the balance sheet of £3,240, which is option B. So the correct answer would be, that's the net receivables figure that will appear on Banger's balance sheet at year end. The key thing to be aware of, the key thing that's being tested in this question is it's asking us for the trade receivables balance on the balance sheet. So the correct answer is 3,240 because that's net of the allowance for receivables. If we were being asked for the trade receivables balance in the financial accounts, the correct answer would have been 3,600, which is gross of the allowance for receivables. So you just need to be careful and watch out for that in your exam. Cool, so that's everything I wanted to discuss in this video. That's the allowance for receivables in a nutshell. If you've got any questions around irrecoverable debts or the allowance for receivables, please feel free to fire them off in the comments. If you like the video, please smash the like button and consider subscribing. I'm making tons of videos about the ACA Accounting Fundamentals exam. And yeah, I'll see you guys in the next video.